Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. Past guests include Brooke Reuter talking about contract for deed versus lease to own options. Scott Reeves of Chickasaw Community Bank talking about commercial banking options, which you'll hear more about today. Today's episode is brought to you by Keyrenter Property Management. Keyrenter Property Management. We are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. Listen, Rockford, as you know, since you're an investor, it's hard to line up contractors and get make-readies done in a reasonable amount of time after a tenant leaves a property. Contractors are busy, the work seems to drag on forever, and all that leads to lost rental income. Here at Keyrenter, we line up our dedicated vendors so that turns happen super quickly and we get more money back into the pockets of our owners or investors just like you and me. And that's why no matter what rentals you have, single-family homes, condos, townhomes, apartments, we have the management solutions that you need. Go to keyrenterpmc.com or email us at info@keyrenterpmc.com. Rockford Steele is our guest today. He's a real estate investor and has been for the better part of a decade. He's got a portfolio of rentals still and previously flipped properties as well. Rockford has been a licensed financial advisor and property and casualty insurance agent, and he's been a realtor. Currently, Rockford still manages his rental portfolio and runs Stout Funding, LLC, which is a commercial loan brokerage. Stout Funding specializes in getting funding for investors to fund their deals. Rockford Steele, welcome to the podcast. I've told you many times before, but I'm going to tell you again, you got the best name in the game.
Oh, thank you very much. Pleasure to be here. My normal running joke with my name getting complimented is, thanks a bunch. I thought of it myself, right?
That's actually funny. You came out of the right birth canal, so thanks to your parents. Let me ask you, how did you get started? Lender, how did you get started in this game?
Well, we kind of got to take a few steps back to kind of go down the road to get there. So I'm actually medically retired from the Marines. So I'm 100% disabled. And then when my wife was expecting my son, we decided dad being home all day is probably not a good example. So I went back to school, taking classes I was interested in. I ended up with a bachelor's in economics.
Cool.
And what I found out during my senior year is there's not a whole lot of job openings for somebody with a bachelor's in economics. You had to have a master's, if not PhD. In that current job environment, you would have had to go back for a PhD, and I was done with going to college. So I went to career fairs, ended up, bumping into a buddy of mine that is a manager of a financial advisory firm. And everyone kind of knows, what a financial advisor is, right? You sell investments and insurance for the most part. And so I was like, well, why would you guys be different? And his response was, well, everything we do is needs-based. Whatever's in the best interest of the clients. We have no quotas. We're not beholden to any one company. I was like, so essentially just go out and make friends and see how you can help. He goes, well, yeah. I was like, great. I can do that. I mean, I don't want to just go sell people and stuff, but I can do that. So the first thing they tell you to do is call your friends and family and tell them what you're doing. Ooh, yeah. So I'm going down my list and get to, Ron Harris, which he's known me since I was born. His dad and my dad were business partners and best friends. It's like thinking he's been doing that real estate thing. Here he's been doing pretty well. We should chat. So we met for coffee. He was telling me what type of stuff he was doing. I'm going, okay, so let me get this straight. So you buy these houses in cash. He goes, yeah. You fix it up in cash. Yeah. Then you refinance. You get all your cash back. He goes, well, yeah. And then it pays you. He goes, that's kind of the point. Where are you going with this kind of question, right?
It was so second nature to him.
What's that?
It was so second nature to him.
Yeah. It's like, so essentially you buy free houses and then pay you? He goes, I hadn't thought about it like that, but yeah, I like that. Hey, I'm going to use that. I buy free houses that pay me.
Love that.
This was before Burr became a popular nomenclature, right?
Right.
And so I went home and I was telling my wife about the type of stuff he was doing. And she goes, so why aren't we in real estate? I didn't have a good answer to that anymore. So I called Ron back and said, hey, you mentioned you do coaching and mentoring. How do I sign up? Because right now I know just enough to lose a whole bunch of money.
Right.
So I did coaching and mentoring with Ron and his wife, Angelina. It was a big appeal for us to work with them because they are a husband-wife team and we were to be a husband-wife team building the real estate business. And so that worked out well. What I found is I had a financial advisory business in its infancy. and then the real estate investment business in its infancy, and they were really pulling in different directions. And with my disabilities, I had a limited number of hours that I can really work in a day anyway. So I had to pick one. Well, my wife's not licensed. If my disabilities flare up, she can't take over that.
Right.
But the real estate business probably actually do better. But so we went, I let go of my financial advisory license and, decided to go full-time real estate. And then I had this thought, well, I never got my real estate license because, you can't be a financial advisor and a realtor, because the moment you sell someone a house, then you're guilty of selling away because you've helped someone put money into something that's outside your brokerage.
Interesting.
I got my real estate license. And at the same time, it started getting a little bit harder to find flips. So I was thinking, you know what? I'll just use it. I'll be a realtor.
What year was this?
Oh, I can't remember.
17, 18?
It's been a hot minute.
Yeah.
Yeah. I mean, when I first started in real estate, it was a lot easier to find deals than it obviously is now, right?
Yeah.
And even at that point, it was becoming more challenging, which is why I started to use my real estate license as a realtor. And what I found is I really appreciate the work realtors do, because I don't want to do it. I hated it. And then I was thinking, okay, well, what am I going to do now? It's like, well, everyone I know wants to have a 30-year fixed rate loan on their rental property, but they want to keep it in their LLC. Why don't I'll go find that and I'll sell that, right? That's an easy thing. Everyone I know wants it. So I'm calling around to my referral partners as a realtor, because they're all mortgage lenders. And I got to my buddy, Chris Herford, who owns Stout Lending. And he goes, well, yeah, we can do that, but I don't know why you want to. It's kind of expensive. It's like, well, I mean, how bad is it? He goes, probably like 6.5%. Like, Chris, I'm paying 6.5% on an ARM right now. I'm going to come work with you. We're going to do a whole bunch of these loans.
Wow.
Yeah. And then he got really excited and he goes, all right, you're going to head up our commercial lending division. I go, okay, great. I mean, what all lenders do we have? He goes, we don't really have any. Go find some. And so that's been my baby ever since. It's been 6 or 7 years, something like that, since I took over the commercial lending arm. And it wasn't long after that we split it off as its own company, because there's compliance issues with the conforming residential mortgage broker versus the commercial. And so we just split off in their own company. So we have Stout Lending that does conventional FHA, USDA, and VA. And I still have a license for that. And then, the Stout Funding, which does the commercial lending. Commercial being the borrower is the company, not the individual. It's not specific to property type.
So in commercial funding, it's so interesting. There are not that many people that do 30-year fixed notes, which must be federally backed. I mean, are they federally backed?
Nope.
So they're not. Okay, interesting.
They're basically all these 30-year fixed loans. If they're sold on the secondary market, it's being sold to probably 2 or 3 different hedge funds that buy them all up.
Got it.
I mean, hedge funds, they got to have some consistent income. Those big, large ones, like, I guess a good, so they're owned by either by the hedge funds or some large bank. So like Civic Financial that folded last year and then was acquired by another lender. But they were owned by PacWestern Bank. So Civic Financial was fine, but PacWestern Bank wasn't. So they got shut down and sold. Right.
But it all still flows into the CMBS, the collateralized mortgage-backed securities market. Ultimately, they just take these. It's a different risk profile because it's signed by an LLC instead of by an individual. But
right. So it's not conventional. It's not backed by Fannie Freddie. Right. So it's not a Fannie Freddie loan. The pro with that is, I mean, Fannie Freddie, if you're trying to do a cash out refi, you got to wait 6 months and you got to close in your personal name.
Yeah.
We close an LLC. I mean, I've got some lenders that will even let us close with no seasoning as long as you did some rehab to the property.
Got it. And is there a substantial difference in rate between what a conventional 30-year federally backed mortgage does and a commercial 30-year note?
Traditionally, conventional would be cheaper. Right now, it's not much cheaper.
Got it.
It's basically the same.
And the logic there is that it's federally backed, so the risk is lower, and it's in your personal name, so your ability to walk away from it is lower, and so the risk in totality is lower, so the rate would be better. What stops it from being a large difference right now in terms of the rates?
I'm not actually sure why that's different now. I'm not actually used to the conventional loan not being substantially cheaper. I probably do maybe 1 in 50 loans that would then go and be conventional right now versus in the past, there'd be more that would choose conventional, especially if they're a newer investor, because you can use those, right, and get that better rate. You get the consumer protections with that. The investors that are trying to scale, they don't tend to like conventional because the underwriting is more strict.
Yeah. And so are your underwriting requirements more like visiting a local community bank than a conventional?
For my commercial rental property loans, I don't even need tax returns.
Wow.
Yeah, so it's based off of DSCR as opposed to DTI. So your traditional conventional
versus debt to income.
Yeah. So your traditional conventional loan, they're underwriting. It's still can you pay, will you pay for both cases, but the criteria they use to determine that is different. So will you pay for both cases is determined by your credit score. You have good credit, it means if the money's there, you'll pay your bills.
And define good credit.
It's a sliding scale, right? So if you've got say conventional, I believe you have to have a 620 plus to get an investment property loan. Commercial, if you got a 600 plus, you can get a loan. The better your score, the better your terms, the better your rates, right?
Are there tiers? So 820 to 740 is one, or is it?
It's basically every 20 points you got a break point.
Oh wow, coming down from like an 8. I don't even know what the highest is. 820. What's the highest? 840, 860, something like that.
I've literally never seen an 820.
So let's start at 800. So 800 to 780, there's a break point there. You're going to pay a little bit more interest if you're
it's about the same. If you're 740 plus, if you're 740 plus, it's about the same on the commercial side. On conventional, it still scales all the way up to 800.
Interesting. Tell me a little bit, is there a personal guarantee for the LLC 30-year note?
You still are personally guaranteeing the loan.
Okay.
That being said, I don't know of a single instance where they've enforced the personal guarantee. I mean, you'd have to be in a pretty crazy circumstance in order for the house not to be worth enough to cover your loan, right? Because that personal guarantee basically just says, if the house is not worth enough, you got to make up the difference.
So what is the debt service coverage ratio, the DSCR? What does it generally need to pencil out at on your pro forma in order for the numbers for the loan to work?
Yep. So DSCR, just real quick to, just in case one of your listeners isn't aware, DSCR is essentially how well the property cash flows.
Yeah.
It's rent divided by your fixed expenses, your PITIA, principal, interest, taxes,
insurance and
association dues.
Yep.
So if you have a 1.0 DSCR, that's the minimum for a lot of them. For the ones that are a little more aggressive on rate, they tend to want it to be at least 1.1, if not 1.2 on DSCR.
Okay.
The reason why is that calculation does not include anything for maintenance or vacancy.
Got it.
So if you have a 1.0 DSCR, does that mean you're breaking even every month? Sure-ish, because stuff's going to break and people are going to move.
So that means, let's just take a very simple example. Rent is $1,000. My mortgage is $800. We assume some amount for tax insurance. So I have to have, at a one-time ratio, I've got to be making $800 in order to cover that mortgage after I pay my tax and insurance. That would be a one-time. And if I had $1,000 after paying rent were $1,200 and it's $200 for tax and insurance, and I had $1,000 left over, that would be a 1.2. What's the math on that? 200 over 800 is 1.25 debt service coverage ratio. Just is that roughly right? Okay.
Yeah.
So the higher the debt service coverage ratio, the more that property is cash flowing. If it was $2,000 of rent and my mortgage was $800 and I only had, $200 of expenses, you'd have a really high, more than 2 times.
Yeah.
Cool. Okay. So no enforcement of the personal guarantee for the most part, because normally the property in foreclosure would actually pay for the remaining balance of the loan.
Yep, that is correct. Yeah, I like I said, I don't know of a circumstance. I'm sure it's probably happened at some point. And there's my lunch.
Love it.
I'm sure it's probably happened at some point, which is why that personal guarantee is required. But I don't know. I don't know personally know of a circumstance where that actually happened.
And so
I know of one where they was considering it, but they did not actually end up enforcing the personal guarantee.
Interesting.
Because it's a lot of work for them to try to enforce that, because then you have to go through court and litigate, and is the juice worth the squeeze?
Yeah. So your ingoing hypothesis is that for a few $1,000s, which would be the difference between the sale price of the property and what the loan value is, it's not worth the multiple thousands of dollars and headache of the litigation associated with collecting that money. They just take
Right.
a little bit of a haircut, write it off, and be done with it.
Well, I mean, if an investor is doing 1 to 4 family residential properties and they're in a spot where the lender's having to foreclose and take that over and is considering enforcing that personal guarantee, they're probably in a lot of trouble.
Yeah.
And the moment the lender starts suing them, they're just going to file bankruptcy. And then you just got to get in line.
Yeah.
It's really, I mean, unless for a really special set of circumstances, it wouldn't be worth enforcing.
Right. Why do you think it is rare for commercial lenders to be doing 30-year fixed notes? Why do you think that very few people are doing that?
Yeah. So local banks don't tend to like the long-term fixed rate because it exposes them to the interest rate risk. For the larger hedge funds that are looking for some kind of stable returns, they're willing to take on that interest rate risk because they're okay with getting the return at where that is, right?
Right.
So they're going to have a diversified portfolio. They've got some earning a little bit, and they've got other stuff that they're being pretty aggressive on that hopefully turns out great and they get a massive return, but it may turn out pretty bad and they get a terrible return, and then they still can show to their investors, oh, but look over here, we're still getting money, right? When you're as large as like the BlackRocks of the world, right? I mean, it's hard to place that much money.
Right.
And being able to place a chunk of money and know you're getting a stable return is a plus.
Right. And so why aren't more lenders getting involved in this asset class?
Yep. So local banks generally don't have access to the same amount of liquidity that like a BlackRock does.
Yeah.
I mean, so they can't expose themselves to that kind of interest rate risk. I mean, for example, look at what happened with the banks that folded recently. They thought they were doing something safe and conservative. They bought some T-bills, right? You got these 10-year treasuries supposed to be the safest thing ever, but then they're exposed to that interest rate risk. Rates spiked, right? And suddenly those treasuries are worth way less.
Right.
And so then if borrowers or depositors then decide they want their money, well, the bank can't then just go sell the treasury and get their money back because it's now worth half as much as what they paid for.
Yeah.
If they wait till maturity, they get their initial principal back, but they got to wait till maturity to get that back. So the treasuries they're great, they're conservative, they're safe, right? But you then have that interest rate risk exposure, right? And that's where they got into trouble. And, a couple got acquired, a couple got shut down, right? I know it was bad enough that Chase said, if another one is in trouble, we're not buying another one.
But yeah, our appetite for consumption has declined.
Yeah. There's a certain amount of liquidity that the bank has to have in order to acquire another bank, right? And so they're like, we don't have liquidity to just keep buying all these banks that go under. So they can't just keep using us as a backstop.
Right. Let's talk for a second about rate indices.
Sure.
The long-term fixed lenders versus the commercial lenders. Commercial. Yeah. What's the difference? What is that?
So generally what you see with the short-term money, the loans that are either adjustable or, they're ballooning in 3 to 5 years, they're going to use something more like either the SOFR or the Wall Street Journal Prime Index.
Yeah.
That's typically what you see. So banks right now for preferred clients are using Prime plus 1 is mostly what I see. We have a few local banks on our platform as well. Prime being at 8.5 puts.
So Prime real quick is 3 points above the federal funds rate. The target, right?
I can't remember. I know it's at 8.5 right now.
Okay.
Is where Wall Street Journal Prime is.
Yeah.
But that Prime plus 1 puts banks then at 9.5%. Right. And that's why a lot of investors that when their loans are adjusting or maturing, they're then calling someone like me because we have other options. Like we cash flowed at 5, we cash flowed at 6.5. We would have cash flowed in the 7s. We don't cash flow at 9.5.
Right.
So they're and bankers like referring to somebody like me because we're non-depository and banks need deposits.
Yeah. So wait, the idea there is that they can actually come and borrow from you, but they'll leave their deposits at the bank. So the bankers are happy that happens.
Yep.
Got it.
That's absolutely correct.
Right. And so what index are you using? How are you basing the rates for your loans right now?
Yeah. So for the 30-year fixed lenders, the ones that are long-term fixed rate, they tend to use either the 5 or 10-year treasury is what I've seen most.
Okay.
Yeah. So over the last week or so, the 5 and 10-year treasury have both come down a lot. So I've seen some massive improvements on rates, which is fantastic.
Wow. So what rates are you seeing now? We're talking middle of December 2023. What rates are you seeing right now?
I quoted one yesterday in the low 7s.
Whoa. That's
Now
pretty significant.
that borrower was not taking cash out. So there's that, because there's a hit if it's a cash out loan versus a non-cash out loan.
And is that basically 50 basis points generally?
Yeah,
or is it more like a
it's
point?
more or less 50 bips. Yeah.
Okay. Interesting. But low 7s, that's pretty significant. Okay.
Mm-hmm. So compare that to a couple weeks ago where I had quoted investors all the way up in the 9s. I mean, we're still like 9.25, so we still were less than what the bank would have done. But
yeah,
I kind of got used to quoting in the 4s a couple of years ago.
Oh my God. Weren't those the good old days? But you weren't just quoting in the 4s. You were quoting like hundreds of deals a month in the 4s or something like that. I mean, it was like the chaos and craziness of COVID was pretty wild.
I was doing commercial investment property loans in the 4s. It was fantastic.
Amazing.
And
yeah.
I mean, then
but all those people locked in for 30 years, right?
Yeah. And it was locked in for 30 years. Yeah. Wow. And then, of course, you've heard the saying, cobbler's kids have no shoes, right?
Right.
Whose properties didn't get done during that period because I was so busy doing everybody else's?
Yeah. Wow. I mean, I wish I'd known you during that period, because I think I'm locked in at 5 years. A lot of those deals, 5 years, 5.25, 5.75. But those are going to eventually adjust, and I'm not going to be happy when even in 3 years, if rates have come down a little bit, they're still going to be at 6.5, 7, something.
Yeah. I had, I think, I don't remember exactly, but I had several loans adjust this year, and I had to figure something out.
Wow. Yeah. I mean, so one thing that I've heard happening is that some commercial local banks are just saying, okay, I'll go to a 25-year amortization. And because over the last 5 years, you've knocked down a huge chunk of huge. I mean, it's 20-year am. You've knocked down a chunk of your principal. I can recast that new principal amount over 25 years, and it still leaves the DSCR where it is palatable for everybody.
Yeah. I mean, they're trying to make it work. I mean, the bank doesn't want you to take your business elsewhere. They especially don't
want to take back the property.
Yeah. They don't want your house. Let's put it that way. They don't, because if a bank all right. So the way the banks can lend money, and the way they can lend more money than their deposits, they're allowed to lend 10 times what their deposits are, right? But if they have to reclaim an asset, it doesn't just eliminate that portion of the asset. It eliminates all the multiplier that they would have been able to lend off of that initial principal. So they really do not want to have bank-owned assets.
Yes.
REO is really bad for a bank, which is why, a lot of the local banks that are like small town banks, they'll have investors on speed dial. If they have to take one, they're calling them immediately. Will you buy this? I've always wondered how you get on that list. I've never figured that.
Yeah, a lot of people would like to be on that list. A bunch of people with a bunch of cash want to be on that list.
I'm sure it's the owners of the banks, good buddies. It's probably how you get on that list.
It's speed dial, good friend. Let's talk about some of the success stories of Stout Funding. Okay. People must come to you all the time. They, like many lenders, you don't get every deal, you don't land every deal. But what are some interesting deals that you've seen recently where you found success?
Well, so being a broker, we have a large amount of options as far as things that we can do. So, I mean, the smallest loan I've done was a $30,000 rental loan. I had to do a private money loan for that because most of the institutional lenders won't go that small, right?
Yeah.
And the biggest deal we bid on, we did not get to close it. You mentioned we don't get to close everything, but that deal was $1.2 billion.
Wow.
It was going to be a hotel, marina, and casino, right?
Wow.
His banker had told him no. And then so me and the lender, we put our heads together, figured out a way to make it work, because they didn't have 20% of 1.2 billion to put down, right? And so we put together a plan. We're going to do this in tranches, right? Do a section at a time. And then he took that plan to the bank. The bank said, yeah, we'll do that.
Oh, no.
We'll do that.
Wait, so what was the idea? Like a construction financing with stage gates, essentially?
Yep. So we would just do a portion at a time because he would have 20% at a time. And as he did each piece, it would then have additional equity that we could leverage to count for that extra 20%.
Right. But then why would he go through to if you guys were offering the solution, why would he go back to his commercial lender? Were rates better with them, or they had some better terms? How would that work?
Cheaper. Yeah.
Got it. In terms of the upfront cost, or in terms of the what do you call it? The points that you need.
Yeah, origination fees.
Origination fees. Yeah. Okay. Interesting. So you didn't win that one, but you're bidding on massive deals, and you can do everything in between. Yeah,
that was fun to be a part of for a while.
Wow.
Yeah. So,
and is that deal getting done, by the way? I mean, that it's been funded and now. Are they doing that? Are they doing that project?
Well, they came back later and asked for a loan for a different portion of it. So I don't think so.
Got it. Interesting.
I mean, yeah, I've bid on a couple steel factories. I think it's basically the same project, just two different clients wanting to do it.
Yeah.
It pretty much in both cases, they didn't have 20%. Like we were going to line up 100% financing. The lender just asked you put 20% in this escrow account for oops and what ifs, right? Because you got a project that large.
Yeah.
You got to make sure you've got something set aside for that, right?
Yeah.
And then at the end of the construction period, everything's done, everything's good. They would release that 20% back to you. So it's not actually injected into the project. It's just held in escrow, right?
Right.
But the borrower had 20 million, not 20%.
Yeah.
So couldn't do that.
I mean, that's ambitious. If somebody has 20 million bucks and they want to do $1 billion+ project, that's an ambitious. That's ambitious.
Yeah. The borrower was in hotels. He did very well in hotels. And then, he wanted to do that. He was bringing in a partner that knew how to run steel factories, and he was the U.S. based side and was going to kind of run the office. Wow. And it didn't work out. They had equity in their hotels that we could have tapped in to get there, and he didn't want to do that. So I mean, that one went away. And then the second stab at it, the borrower didn't have the liquidity in the United States. They had plenty of money not in the United States, which became problematic because apparently you can only move a certain chunk at a time, and it would have taken a really long time to get the money here.
Got it. Interesting. Other successful recent stories?
So I've got one in underwriting right now where it's a warehouse actually up in the Tulsa area. Cool. And the borrower, we started taking a look at it, and the borrower opted to go a different direction. The other bank gave them a really good song and dance about how they're going to get this done. We're going to get it done in a timely manner. And, they actually were trying to take it SBA because they were buying the business that was housed in the warehouse as well. Mm-hmm. I mean, no fault to our borrower. The seller's financials were a mess.
So they couldn't underwrite. They couldn't underwrite the business, and then the loan associated with the business as a result of the seller's
because the business's financials were a mess, and so you can't take a deal like that SBA. We can do SBA. I wasn't going to take it SBA just because of timeliness. Yeah, because I've seen those take 6 or 8 months, and we didn't have 6 or 8 months. Right. Yeah. So they came back and said, "Hey, can we get this done?" And so we've got that in underwrite right now with one of our local banking partners. I think he's getting a rate in the 7s as well. So nice. When you do volume, it's like we do as a broker, sometimes you can negotiate some special deals. Yeah. So a local bank that is willing to do something other than Prime Plus, right?
Excellent.
Yeah. So it helps. Volume has leverage. I mean, another big win for us recently is I go to a lot of lending conventions because I'm a broker. I'm always shopping lenders, right? Our little slogan is we shop lenders because you got better things to do, right? Because you're trying to find deals, you're running rehabs, you don't have time to call 40 different banks, right?
Yeah, right.
So we had a lender we onboarded, and they had these crazy insurance requirements that we were not aware of till after we had submitted 10 loans. And so we had 10 loans in underwrite with them and trying to navigate these crazy insurance requirements. And about half of them didn't close because to meet their criteria, the insurance costs doubled.
Whoa.
And it killed deals, right? At the convention, I happened to run into one of the directors with that lender. And he was asking for feedback because we signed up, we sent a bunch of loans, and we sent nothing. He's like, "What happened?" So I laid out to him, "This is what happened. This is why I'm not sending anything. You're asking for something on the insurance where the lender has no insurable interest in that part of the policy that you're trying to be on.
Yeah.
The insurance agents that have reasonable premiums won't write that because you don't have insurable interest.
Yeah.
And he goes, I don't even know why we're asking for that. I'm going to check it. This will get fixed. And it's fixed now. But that's a huge thing because they were always really excellent on rate. It's just, I couldn't send them anything because it's going to kill deals. Right.
Yeah.
So, we just had a closing with them with the new insurance criteria. So that was a win. We'll take that.
Excellent. Tell me a little bit about your construction financing on projects. I buy a project for 40 grand. I want to put in 100 grand. The after repair value is, let's just use round numbers, 200 grand. Where do you what will you fund when? All
right. So if you're buying it for 40 and putting 100 in, that sounds ground up to me.
That's a lot. We do that all the time though. We buy these things, they're burnt units, but they're in a good neighborhood or whatever.
I resemble, the biggest rehab I did is we bought it for 65 and we put about a little over 90 into it. Right. I understand, most lenders do not like what's called a lopsided deal, where your rehab is greater than your purchase price. Kind of the sweet for that to get optimal pricing is your rehab is between 20 and 80% of your purchase price.
Okay. So let's do that. Let's use an example where we're buying for 100 and putting in 50 and it's worth 200 at the end.
Yeah. So if you're buying it for 100 and you're putting in 50, the most aggressive that we're probably going to see without going to our private money lenders, because private money lenders, we can do up to 100%, not to exceed 70.
100% of the total cost, not to exceed 70% of the after repair value. Got it.
And then with my institutional non-bank, you're probably looking at financing up to 90% of purchase, not to exceed 90% of purchase, 100% of rehab, not to exceed 75% of the completed value.
That's great. So in this case, 75% of the completed value would be 150 on 200. Yeah. And if we bought it for
buying it for 100 and putting in 40, you're going to get that 90-100 program.
Got it.
All that being said, if you've got time to wait for a pre-approval from the bank, I do have a local bank that will do 100% finance, 100% of purchase, 100% of rehab, not to exceed 75% of ARV. It is a rehab to rent loan. So one closing, right? You don't have to refinance. It rolls right into a 3-year balloon rental loan. So it renews every 3 years. They charge a little bit more upfront for origination for that program.
They have to inspect the construction and a bunch of other stuff, I guess, right?
Well, so if you do a fix and flip loan, they don't inflate the origination. It's because it's rehab to rent, so they have to do the work twice, but they don't make you close a loan twice, right? So you don't have to pay title twice, and there's no second appraisal or anything like that. There, as you might imagine, any bank that's an actual bank doing 100% finance, they're swamped. So initial turn for an underwrite is probably like 45-ish days.
Got it.
So I've got a few of those in queue.
But that's awesome. They'll do 100% not to exceed 75% of the ARV. That's awesome. If you can find those deals. My God, it's hard to find those deals though. If you're able to have 150 into a deal, that's worth.
You got to bring a little bit down, right? Yeah. But they'll also fund the entire rehab at closing. So even if you're a little bit lopsided, since they fund the whole deal at closing, you're still not bringing cash to close, and you just end up doing some rehab out of pocket.
So do you need, they will cut you a check at closing, or do they want to draw on the construction?
That bank will cut you a check at closing. It goes it goes to title, and you leave with a check.
So if you're actually able to do the construction, in my example, I did 100 acquisition, 50 renovation, it gets you to 75% of the ARV. If you're actually able to do the renovation for 45, you actually could pocket $5,000 for your next deal, amortized over 20 years, but adjusting every 3.
Amortized over 25.
Amortized over 25, adjusting every 3.
Yep.
Wow.
Yeah, so it's a renewal every 3 years. You'd have a doc fee every 3 years to renew the loan. They are one of the banks that does prime plus 1. So you're going to be at 9.5, 9.75 is where I would expect most borrowers to be with them. But if your cash doesn't have to touch the property, that's a win.
Yeah.
Right. Personally, with where my 30-year fixed lenders are, I'd probably use their fix and flip loan options, save a little bit on the origination fee, get in there, get it done, and then refinance on a 30 years fixed. That way, if rates do spike again, like I think they might, you don't have to worry about it. It's fixed. And then if rates go down, after your prepay is over, then you can always refinance to lower your rate.
Which of these loan programs have some sort of prepayment penalty? What do they call that? They call that management. What do they call it? Cash. What do they call it? There's a term for it that small balance loan program Freddie and Fannie use for big apartment complexes called.
Oh, the yield maintenance?
Yield maintenance, exactly.
Yield maintenance is probably the worst type of prepayment penalty you can see.
I paid some. It sucks.
Yeah. So for those that don't know, yield maintenance means the interest that would have accrued, that you would have paid, that is your prepayment. That's bad.
That's bad.
Most do a stair step. So if it's a 5-year prepay, it's 5 the first year, 4 the second, 3 the third, right? It goes down. And then after 5 years, you're done.
And it's the yield maintenance terminology seems to be the bank's way of saying we are making sure that we can forecast our yield to our investors over time. It's not an investor facing terminology. I mean, it's similar to the way a bank does debit and credit. Your debit card, which is one side of the accounting ledger thing, debit is actually referring to the fact that it's a debit from the bank's perspective, not a debit from your perspective. We know Correct. It as debit card. So it's like they call it yield maintenance, which is a bank's inward looking. It's as if this terminology that was a bank's inside terminology got leaked to the public, and now we all know it as yield maintenance, but it's a bank's terminology, which is a little bit bizarre. But anyways, so what are the yield maintenance or what are the other prepayment penalties that some of these programs enforce?
Yeah, so the 30-year fixed lenders, they're pretty much all their default is a 5-year prepay. So it is that stair step 5, 4, 3, 2, 1. Some of them offer yield maintenance, but there's not a whole lot of savings in rate for doing that. So there's really no reason to do that. Yeah. You can also buy down the prepay and get a shorter, like a 3-year prepay or a 1-year prepay.
But if your strategy is to buy and hold, you probably don't want to do any of that stuff.
Yeah. I've had several that wanted to do the 3-year instead of the 5 because they figure after 3 years, they expect rates to be lower and they want to be able to refinance at that point.
Yeah.
I haven't had anyone buy it down to 1 year yet. I saw a post online. Someone was looking for a no prepay 30-year fixed loan. It's like, well, I mean, you can do that, but the rate's going to be a lot higher. It's going to make sense to refi real soon.
But that means that they expect in a year rates to be significantly lowered, such that once they pay an origination fee and a closing fees twice, once now and once in a year, it's going to still make sense. That's pretty ambitious in terms of where you think rates are going to be.
Yeah, normally if you're thinking that, we would just do another bridge, right? Because you can bridge into a bridge, right? I mean, sometimes it's necessary.
Yeah. When would that be necessary? When renovation just takes longer than expected?
Renovation takes longer than expected. I've done a bridge loan because the borrower needed cash. Bridge loans close faster, and the property wouldn't meet DSCR criteria.
Right.
Because bridge loans don't commonly use the DSCR. It's all about loan to value, and that's really all they're underwriting. You're not meant to be in it for a long time, right? You're meant to be in it for 12 to 24 months.
And bridge loans are generally, they don't amortize. They're just interest only, aren't they?
They don't amortize. It's just interest only.
Right.
So it bought the borrower an extra couple of years to be able to then get rents up, get things sorted, and then you can do a normal stabilized loan on the back end of that.
What are all the assets that you lend on? You've mentioned marina, hotel, you've mentioned steel manufacturing, you've obviously mentioned rental properties. Do you lend on a broad array of assets or is it mostly real estate backed?
Yeah, so I'm a broker. So the beauty of that is if I have a lender that will lend on it, I'll lend on it.
Got it.
So like trucking, we can lend on trucking. We can lend on real estate, obviously 1 to 4 family. I think the only thing related to real estate we have trouble with is vacant land with no plans to develop, less than 20 acres.
Less than 20 acres. So if you have vacant land with an architect's renderings of drawings, and do you need some sort of anything from a planning commission or from the city that indicate that you're zoned properly or anything else?
Yeah, if you've got plans to develop and build it, we can just do it as a development loan, right? So that way you can get a loan for a portion of the land, right? Lenders don't like to lend a whole lot on loan to value on land because it's not revenue producing.
Right.
So if you're about to do something to make it revenue producing, then it's a lot easier to get them on board.
Got it. So you do a bunch of different types of asset classes. Where do you lend? In Oklahoma?
So for conforming conventional type loans, I'm only licensed in Oklahoma.
Okay.
For commercial loans, I think we're in 43 states.
Wow. So
Used to be more.
if I want to borrow commercially in, I don't know what the states are, 43. There's 7 I could mention that aren't, but let's say Kansas, you can do the loan in Kansas. No problem.
I can do the loan in Kansas.
Got it. And does the appraisal have to happen via a real licensed appraiser, $450, or can it be done via desktop?
It's going to need a full appraisal. I mean, pretty much across the board. The ones that do a hybrid, it still ends up costing about the same. I mean, maybe it's a little bit cheaper, but they send someone to go take pictures. So you still have somebody going in, taking pictures and giving a price opinion, and then they do an internal valuation.
Mm-hmm.
But for the most part, it's a full appraisal. Appraisal costs when you're ordering it through an AMC, appraisal costs have gone up. I normally see in the ballpark around $750 for appraisals, which it's better than it was during COVID. During COVID, it got as high as like $1,200-1,300 for standard appraisal. I had one quoted $2,400 for a 6-week turn time on a 1 to 4 family residential appraisal.
We should go be appraisers.
And that was the best offer at that time.
That's crazy. The weird thing about appraisals that like systemically it's an issue because an appraiser, in order to get licensed, has to apprentice under another appraiser. So the appraiser that is overseeing the apprentice is essentially training his or her own competition. So there's, I guess, that creates,
and it's a lot of work to train a new appraiser, right? Because you can't just like use them as staff and hand them tasks to do because you're responsible for everything they do. So you still have to review and look over every single report that they put together, right? So it's not as though you get to just use them for labor during the apprenticeship period. You still have to redo all the work that they just did to make sure it's right because you got to put your name on it.
Does there need to be?
That is a problem. It's, in my experience with AMCs, appraisal management companies, for those that don't know what AMC stands for, they're a repository for bad appraisers, right? Bad appraisers get to stay in business because of AMCs. A lot of our lenders have, on the commercial side, not conventional. Conventional, you have to order through AMC, and you don't really get to say much about, which appraiser is going to use it. On the commercial side, I have several that let us pick an appraiser, or at least put together a panel of our own appraisers that we like. Then it'll go to our list. We want one of these guys because we know these guys send good reports, right? Guys and gals, right?
Right. Is there a structural issue in the industry that needs to change?
There needs to be a better way to get rid of these bad ones. Because I got a bad one just this week, and then we did a reconsideration of value, saying, hey, please, look at these comps. These are ones we feel should have been used. And the appraiser said, no, we're not changing anything. And then I looked at his name. It's like, oh, it's that guy.
Right.
I've gotten appraisals from him a few times, and I've never gotten a good one. Yeah. But because he's set up with different AMCs, if I blacklist him with us with one, but the order goes to a different AMC, he's not blacklisted with us with that one. And so I get him again anyway.
How do people find you if they want to take advantage of some of these very interesting programs that you offer?
Yeah. So best way to contact me right now is email. As you might imagine, I'm on the phone a lot. So if you call me, I may or may not answer. If you text me, I can't mark a text message as unread, or if there's a way to do it, I don't know. But email, if I'm in the middle of something, I can mark it unread, and I can respond to you as I can. My email is just rockford@stoutfunding.com. So Rockford, ROCKFORD @stoutfunding, STOUT funding.com.
Cool.
And you can also find us. We have a website, just stoutfunding.com as well. We just got an application thing set up, so that should be appearing on our website in the next week or so.
So if somebody wants to start a new application, they just go right to Stout Funding, the Stout Funding.
They just go to stoutfunding.com. It's a short form app, so it's just enough information for us to get an idea of what you're wanting to work on. And then more likely than not, we'll reach out to you via phone or email to get a little more detail to make sure that we can make sure we're on the same page. As it says on our website, it all starts with a conversation, right? Because just because you're looking for a rental loan, we got to talk about, well, what is this property? What is this deal? What's your goal? What are you trying to accomplish? Because we want to make sure we're in line, working in the direction you want to go. Last thing I want to do is, this did happen recently. There was a communication mix up, and they were looking for a stabilized rental loan, and it was a purchase. We thought it was a fix and flip deal, and we were underwriting in the complete wrong direction. And unfortunately it happens, but we were able to get it sorted out. But thankfully that my processor caught what I missed, and it didn't cost us too much time.
Good. Rockford Steele is a real estate investor and has been for the better part of a decade. He has a portfolio of rentals still and previously flipped properties as well. Rockford has been a licensed financial advisor. He sold property and casualty insurance, and he's been a realtor. Currently, Rockford still manages his rental portfolio and runs Stout Funding, LLC, a commercial loan brokerage with all the options and programs that we discussed today. Super exciting. Stout Funding specializes in getting funding for investors to fund their deals. Rockford, thank you for being on the show. We appreciate it.
Thank you for having me.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.